Oil prices have risen in recent times, and this has affected people in various ways. Here are some key points about the rise of high oil prices. 1. Gasoline prices. As oil prices rise, drivers pay more for gasoline, and truckers pay more for diesel. 2. Supply and demand. The rise in oil prices is due to a combination of factors, including tight supply and concerns about future global economic growth. 3. Inflation. The rise in oil prices is also seen as a bad omen for inflation, as it threatens to push gasoline prices even higher. 4. Impact on Russia. The rise in oil prices is also helping Russia's war efforts, as the country relies heavily on oil exports for revenue. 5. Interest rates. The Federal Reserve is determined to increase interest rates for as long as it takes to bring inflation down, which will ultimately cause the economy to weaken further. The rise of high oil prices has significant implications for the global economy, as it affects everything from the cost of transportation to the price of goods and services. Hi and welcome to Planet Economy. Make sure to stay till the end of the video so you keep yourself up to date about the recent changes around our economy. Make also sure to subscribe in order to support our channel and to keep yourself informed about our upcoming videos. And of course, leave a like and comment down below. Tell us about your daily life and how things have changed throughout the years while the cost of living is rising, sadly said. According to a recent article on Yahoo News, high oil prices are currently manageable, but the situation is precarious. Here are 5 reasons of growing higher oil prices. 1. Current situation. Oil prices have risen by around $20 a barrel in the past 6 months, which has led to higher prices at the pump for consumers. 2. Manageable for now. The article states that the current high oil prices are manageable for now, as the global economy is still growing and demand for oil remains strong. 3. Potential risks. However, the situation is precarious, as any number of factors could cause oil prices to spike even higher. For example, geopolitical tensions, natural disasters, or a sudden drop in demand could all lead to higher prices. 4. Impact on consumers. Higher oil prices can lead to higher prices for goods and services, as transportation costs increase. This can lead to inflation and a decrease in purchasing power for consumers. 5. Impact on businesses. Higher oil prices can also impact businesses, as they may need to pay more for transportation and energy costs. This can lead to lower profits and potentially job losses. While high oil prices are currently manageable, the situation is precarious and could change quickly. Consumers and businesses alike should be prepared for potential price increases and take steps to mitigate the impact on their finances. A French bill has moved the deadline for food price negotiations up to the middle of January. Previously, the deadline was March 1st. But now food retailers and producers in France will have to conclude annual price negotiations by January 15th. This change is intended to help combat rising food prices and inflation in France. Food retailers and producers in France are reacting to the new deadline for annual price negotiations. However, some of the articles suggest that there have been recent negotiations between food manufacturers and retailers in France to set the lowest possible price on a range of products. Additionally, there have been talks between the French government and food retailers and producers to cut prices on 5,000 everyday products. It is possible that the new deadline for annual price negotiations could lead to some tension between food retailers and producers, as they will have less time to negotiate prices. However, without further information, it is difficult to say how they are reacting to the new deadline. Food price inflation in Cameroon has been a persistent issue in recent years, with significant implications for food security and the economy. Here are some key points. 1. High inflation rates. According to Trading Economics, Food inflation in Cameroon averaged 3.25% from 2014 until 2023, reaching an all-time high of 16.4% in November of 2022. Inflation rates have remained high in 2023, with a general inflation rate of 6.61% in August 2022. 2. Impact on food security. High food prices have significant implications for food security in Cameroon, particularly in conflict-affected areas. According to FuseNet, retail prices of imported staples, including wheat, rice, frozen fish, and vegetable oils, remain significantly above 5-year averages and last year's averages, underpinned by high shipping costs and global supply chain disruptions, have continued to reduce domestic supplies. 3. Impact on the economy. High food prices can also impact the economy, as they can lead to higher costs for businesses and consumers, potentially leading to lower profits and lower purchasing power. Inflation rates have remained high in 2023, with a general inflation rate of 6.61% in August 2022. 4. Efforts to address the issue. The World Food Programme, WFP, has been working to address food insecurity in Cameroon, particularly in the aftermath of the Russian-Ukrainian crisis. The WFP has been providing food assistance to vulnerable populations, including refugees and internally displaced persons. U.S. winter heating costs are expected to rise for most people, while natural gas customers will see a drop. Here are some important factors to look at. Natural gas heating, which is used by just under half of U.S. homes, is expected to cost an average of $726 this winter, down 7.8% from last year. Heating bills for those with natural gas will jump 28%, $931, according to the EIA. Heating oil costs will rise by about 27%, $2,354. Home heating this winter will cost an average of $1,162 across all fuel types, according to EIA's January projection of total average costs for the season. Those who heat with natural gas will pay an estimated $828 over the course of the winter, down $103 from the initial forecast. We expect U.S. electricity prices for residential customers will be 6% higher this winter than last winter, at an average of 14.8 cents per kilowatt-hour. Natural gas prices have fallen in the first half of 2023 amid record production and mild temperatures. U.S. winter heating costs are expected to rise for most people, with natural gas customers being the exception. The cost of heating oil is expected to rise significantly, while electricity prices are also expected to increase. BMO predicts that no rate cuts are expected until the second half of 2024. BMO's new forecast is for a total of 50 basis points, 0.5%, of rate cuts in 2024, down from its previous forecast of 75 BPS. It expects the Bank of Canada to cut interest rates by 50 basis points in each quarter of 2024, to take the policy rate from 5% down to 2.5%. Just over half of economists surveyed by Reuters said the Fed will hold off cutting rates through March, with another 45% saying its first cut will come in Q2 2023. The Fed managed to out-hawk expectations with fewer expected rate cuts in 2024 in the dot plot. BMO's senior economist stated in a video that interest rate cuts are not expected in 2024. BMO predicts no rate cuts until the second half of 2024, with the Bank of Canada expected to cut interest rates by 50 basis points in each quarter of 2024. However, there are differing opinions among economists, with some predicting rate cuts in Q2 2023. The potential negative impacts of no rate cuts on the housing market include reduced demand. If interest rates remain high, it could reduce demand for homes, as higher interest rates make it more expensive to borrow money to buy a home. This could lead to a drop in home prices, as fewer people are able to afford to buy homes. Reduced affordability. Higher interest rates can also make it more difficult for homeowners to afford their mortgage payments, which could lead to an increase in foreclosures and a decline in home values. Reduced investment. If interest rates remain high, it could discourage investors from investing in the housing market, which could lead to a decline in home values. Reduced construction. If interest rates remain high, it could discourage builders from constructing new homes, which could lead to a decline in the supply of homes and an increase in home prices. In short, the potential negative impacts of no-rate cuts on the housing market include reduced demand, reduced affordability, reduced investment, and reduced construction. These factors can have significant implications for the housing market and the economy as a whole.